So this question, called Bravado, is a step acquisition in respect of both a subsidiary and an associate. There's an awful lot going through the question. Therefore, it is absolutely essential that we start off by setting out our pro forma. And all I've done, I've simply taken the headings from the question itself and added in Goodwill and added in, oops, I've not even done that. I should have added in NCI as well. And leave plenty of space. That's the one thing I would say for these exams. In terms of our group structure, let's work out what's happening here. We've got Bravado investing in Message. Message is a subsidiary with 80%. We've also got Mixed-Ed, 6% plus 64%. And we've also got Clarity, which becomes an associate, 10% plus 15%. I think it's really important to work our way through the question line by line, bit by bit, step by step, as always. Really important. So we start off with our three companies, and all that we're doing initially is simply adding up figures. So for PPE, I've got 656. Then we've got our investment in subsidiaries. For Message, I'm going to put in a cost per the SFP of 300, and for Mixed-Ed 133. We've got our associate Clarity, so I'm going to have an associate note, cost per the SFP is 20, and investment in equity instruments, I'm going to add them together. Investment in equity instruments simply means that we own shares in other companies. Inventories 263. Receivables 168. Cash 210. Share capital is that of the parent company, which is 520. We then have the share capital of our two investments, our two subsidiaries. So pop down to working number 2. SC, perfectly adequate for share capital. Don't worry, the examiner is not going to try to second guess what SFP and SC means. And remember, we do this at the acquisition date and the SFP date. We don't need to do 3 because we don't have an equity investment. And SFP and acquisition. So I've got figures of 220 and 100. Retained earnings, and I'm a great believer is if I'm working on a particular working, let's just slot in these figures. So for Message 150, and for OCE 4, for Mixed 80 and 7, and for the parent I've got 240 and 17. So the parent's figures we're going to take to working 5, where I've set up separate columns for retained earnings and other components of equity. Just get into that routine. There are marks given in the exam for doing this, so let's make absolutely sure that we pick up those marks. Long-term borrowings, 140. Deferred tax, 37. Trade payables, 205, and tax, 92. So I'm simply taking the information given to me by the examiner and putting it somewhere which is going to earn me marks in the long run. Then we come to the additional information. There's a lot of it and it's complicated, so let's deal with it line by line. We acquired 80% of Message. The purchase consideration was cash of 300 million. The fair value of the net assets was 400. So we go down to net assets. I'm going to say here, fair value of the net assets is 400, including any deferred tax liability. The owner of Message had to dispose of the entity for tax purposes and therefore sold the entity to the first company to bid for it. So this is sending out a signal that potentially, because the previous holder was desperate to sell, they might have sold it cheap. An independent valuer has stated the fair value of the NCI in Message was 86 million at the acquisition date. So I'm going to go to my Goodwill calculation. Fair value of the NCI is 86 million. Go to the NCI calculation at acquisition for Message, 86 million. The retained earnings of Message were 136. And other components of equity were 4. If we add those up, that comes to 360. The excess of the fair value of the net assets is due to an increase in the value of non-depreciable land. So our fair value adjustment, it's the balancing figure. And that balancing figure is 40 million. And that 40 million is in respect of land. So I'm going to go up to here, 40 million from working number 2. Because it's land, we don't have to depreciate it, so no further adjustments are required. But the examiner does have a habit of giving you the overall fair value total and expecting you to work out the fair value adjustment, which is our balancing figure. So that's note A dealt with. On the 1st of June X7, we acquired 6% of Mixed. We treated this as originally as an investment, and we'd taken gains and losses through OCI. That's perfectly acceptable. There were no change in the fair value to the 31st of May X9. On the 1st of June X8, we acquired a further 64%. For 118 million. So if we take a look at that note, can you see that if we add the 10 and the 118 together, that gives us a grand total of 128. But I take a look at my statement of financial position. In my statement of financial position, the figure is 133. The reason for this is that we've revalued the investment, and you're under IFRS, you're allowed to revalue investments and take gains and losses through to OCI. So what the company has done, it's gone debit investment 5 million, credit OCI or OCE 5 million. That's fine, nothing wrong with that at all. So we don't actually require an adjustment at this particular stage because that adjustment has been put through. The company's already done that for us. But under the purchase agreement, Bravado is required to pay the former shareholders 30% of Mixed Ed's profits for each of the years X9 and Y0. The fair value was measured at 12 million. So we call this deferred consideration. We're going to pay this at a later date. And how much are we going to pay? We're going to pay an extra 12 million. So I'm going to add that onto the cost of the investment. Now that actually should be, of course, in Mixed Ed's column. But for every debit, there's got to be a credit. So if I'm going to go debit cost of investment 12 million, I've got to set up a liability for the same amount. So I'm going to go to liabilities, and this is my deferred consideration, 12 million. So that's the first part of note B. It then says the fair value of the equity instruments before the business combination was 15 million, which explains the movement of 5 million. And the fair value of the NCI was 53. So if we go to fair value of NCI, 53, that goes into our Goodwill calculation and into our NCI calculation. The retained earnings and other components of equity were 55 and 7. And we're told the fair value of the net assets, excluding deferred tax, was 170. The excess of the fair value of the net assets is due to an increase in the value of PPE. So how much is the adjustment we're looking at? Well, the book value, the carrying amount of the assets, is 162. So therefore our fair value adjustment must be the balancing figure of 8 million, credit our net assets working, and debit PPE 8 million. The fair value of the PPE was provisional, pending receipt of a final valuation. These valuations were received on the 1st of December X8. You are allowed a retrospective calculation of the net assets and goodwill within 12 months of acquisition. This is within 12 months. So here we have a further adjustment of a further 6 million on the 1st of the 12th X8. So I'm going to increase net assets, I increase equity by a further 6 million. If I increase equity, I've got to increase the other side of my SFP by 6 million as well. This increase does not affect the fair value of the NCI. PPE is depreciated over 7 years. Can you see what I've done here? I've increased the value of PPE by 14 million in total. At what date? Well, this is the 1st of June X8. We're looking at the accounts at the 31st of May X9. So we need to charge 1 year's depreciation on the adjustment that we've made of 14 million. So I've increased assets by 14 million. I've got to depreciate that 14 million. 1/7 of 14 million is 2 million. So I'm going to take that out of assets, depreciation, 2 million. We're then told the tax base of the net assets was 166. So the examiner's being mildly evil here. So let's just remember the principles behind deferred tax. What we do is we compare the carrying amount. So the first thing you always do, step one, we've just established that the fair value of the net assets, the carrying amount of Mixed's assets, is 176 million. The tax base we're given in the question is 166 million. So this is a taxable temporary difference of 10 million. Our SFP figure is 10 million and our tax rate is 30%, which gives us a 3 million liability. Because what you do is that you take your temporary difference and you multiply that by the tax rate. So that gives us a 3 million liability. So it's going to be credit deferred tax liability and debit the reserves of Mixed by 3 million. So I'm going to take that deferred tax liability, adjustment of 3 million, up to my SFP, deferred tax, plus 3, and that's come from working number 7. We're dealing with Mixed. Deferred tax from working number 7, whatever working it is, where the 176, so the 176 is our net assets at acquisition. So the deferred tax arises at acquisition. Note D, that's fine. Note E. Bravado bought shares with an overseas investment, and it's not recorded any change in the value of the investment since the 31st of May 20x8. So what I'm going to say here is the value at the 31st of May x8, we've got a fair value is 10 million dinars, and there are 5.1 million dinars to the dollar. So that gives us $51 million, but at the 31st of May x9, the fair value is 7 and the exchange rate is 4.8, which gives me a figure of 33.6 million dinars, and we are told that that is an impairment. So that impairment works out as $17.4 million. How do we adjust for that? Well, that's going to be credit our investment. And that adjustment, because we've got an election to put gains and losses through OCE or OCI, I'm going to put that 17.4 through group OCE. So let's go to group reserves. Investment 17.4, that's come from working number 8. And I'm going to go up to investments in my statement of financial position, less 17.4 from working number 8. Do you see, every time I put through an adjustment, I'm thinking journal every time. Think debits and credits, and you're always going to balance. Note F, Bravado manufactures equipment. Inventory is valued at cost, but we know, per IFRS, we should value it at the lower of cost and NRV. So I'm going to have an inventories note. I think it's a bit complicated. We've got cost and NRV, and we've got, at the first stage of production, we've got a cost of 1,000, and the second stage of production we've got a cost figure of 1,500. Selling costs are £10 per unit. We've got 10,000 at the first stage and 20,000 of the finished product. Shortly before the year end, a competitor released a new market, which meant that we reduced our selling price to 1,450. Now, NRV is selling price less selling costs. So our NRV for the first stage of production is going to be $940, and for the second stage of production it's $1,450 less our selling costs of $10. So our NRV is going to be $1,440. How many units do we have? Or sorry, what's the adjustment? Can you see that we're going to have to reduce both cost at the first and second stage of production by $60. So our inventories are overvalued by $60 per unit. How many units do we have? 10,000 and 20,000. So our total adjustment is going to be 0.6 million and 1.2 million. So we've got an overall adjustment to inventory valuations of 1.8 million. Credit inventories 1.8 million. And that would normally go through cost of sales, and cost of sales flow through, of course, into retained earnings. So go to retained earnings, inventories, working number 9, 1.8, and up to inventories minus 1.8 from working number 9. Note G, directors have included a loan in cash. A loan to a director has been included in cash. It shouldn't be in cash, should it? It should be in receivables. So all I'm going to do here is increase receivables by 1 and reduce cash by 1. But if you did that in the exam, you would have picked up a mark. So can you see here that sometimes the least complicated of the adjustments can be the very final one? So the moral of the story is keep going in the question. Because the temptation to jump out of a window is quite strong, isn't it? So therefore I've got figures of 169 and 209, but that would have been worth a mark in the exam. Now we've now dealt with all of the information in the question, and every time you reach that point, what have I forgotten? Oh, I've completely, yeah, sorry, I've completely ignored note C. I've had a senior moment. Do apologise for that. Note C, Bravado acquired 10% in Clarity on the 1st of June X7 for 8 million. And it was then revalued to 9 million, and the company has correctly put through that adjustment. On the 1st of June, we acquired an extra 15% for 11 million. So now we've got 9 plus 11, which equals the figure we've got in the SFP of 20. So that's fine. So when we go to our associate, we've got the cost per the SFP of 20 million. At what date did Clarity become an associate? Associate status was achieved on the 1st of June X8. Clarity made profits of 6 million in the year to the 31st of May X8. Well, we're not interested in that. It wasn't an associate in that year. But our share of the associate profit, it made a further profits of 10 million once it became an associate, and under equity accounting we measure associates at cost plus share of profits since it became an associate, and we've got 25%. So I'm going to increase my associate value by 2.5, and the double entry is debit investment in associate, credit group income statement, which flows through into group retained earnings. So I'm going to credit that to retained earnings, which is working number 5. So now I've dealt with all of the items, including note C. We can take a look at working number 2. And we've got our totals. So for message, net assets have increased by 14, and for mixed, bigger. A big series of adjustments here. Let me just double check that. 187 plus 8 plus 6 minus 5. And for mixed ed, it's increased by plus 20. We're going to use the figures at the acquisition date to determine goodwill. So we say less net assets at acquisition 400 and 176. Those figures have come from working number 2. And for message, there is negative goodwill of 14. What do we do with negative goodwill? It is taken to the income statement in the year of acquisition. Income statement flows through into retained earnings. So what I'm going to do here, negative goodwill from working number 3 is added into retained earnings like so. For mixed ed, 133 plus 53 plus 12 less 176. 22, and we're going to take that figure of 22 into my consolidated SFP like so. Next we've got to deal with the NCI. We've got the NCI at acquisition. We then give them their share since acquisition. For message, 20% of 14 is 2.8. What are we going to do with the other 80%? That goes to the group. That works out as 11.2. For Mixed-Ed, what's happened? Well, the NCI have 30% because we've got 6% plus 64%. So we're going to give them 30%. 30% of what? It's 30% of 20. There's no change in OCE, so we don't have to split the increase in profits between retained earnings and OCE. So 30% of 20 is 6. And what do we do with the other 70%? We give it to the group. Which is 14. Oops, sorry. So we end up with OCE being minus 0.4 and retained earnings to 279.9. I'm going to take those totals to the face of our answer. OCE 0.4 minus retained earnings 279.9. We need to work out the NCI. Do the additions. 59, 88.8. Add those two together, 147.8. Now let's do some housekeeping. So get a grand total 1436.3 for equity and liabilities. This is going to add up. I don't think it is. Oh, I've forgotten the investment in the associate. The associate's 22.5, so that's clearly an asset. and that balances to 1436.3.